My name's Tim Hamrich. I work in ag communications. I've started a podcast about 9 years ago called Future of Agriculture, and that has led to all sorts of fun conversations about ag on the economic side and the technology side. And it's just a joy to get to help facilitate these webinars. But you're not here to see me. You're here to see these three guys. And I want to get each one of them just to briefly introduce themselves and give us the 101 version of what they do, the high level pitch. So Howard, if you don't mind, I'm going to go around the horn and just get intros from each of the three of you, and we'll start with you. Give us the intro, who you are, what you do.
Good morning, everyone. I'm Howard Halderman. I'm the president of the Halderman Companies. That would be Halderman Farm Management, Halderman Real Estate Services. And we basically do three different things. We provide property management services for farms. I want to be clear, for farms. We don't manage commercial space or industrial space, but we manage farmland for individual farm landowners, municipalities, corporations, all throughout the Eastern Corn Belt. So Illinois, Indiana, Ohio, and Michigan primarily. In addition, we provide real estate brokerage services. So we buy and sell farmland. We sell a lot of farms via auction, online auction, open cry auction, just depends on the property and the situation. And then our third service area is that we're doing over 1,100, 1,200 farmland appraisals each year. So the three services for us are property management, real estate sales, and appraisal. And again, it's in the Eastern Corn Belt, Tim. So that's a little bit about me.
Thanks, Howard. Appreciate it. Yeah. And over to the West, Kyle.
Good morning, everybody. Kyle Johnson. I am a lending officer on our commercial grain lending team here. So cover the western half of the state with our larger producers in this area. Born and raised kind of Northwest Iowa and currently live in Southwest Iowa. So work directly with producers to, structure loans and kind of figure out their needs from a capital standpoint.
Great. Thank you, Kyle. And Ben.
Ben Gordon, CEO, co-founder of Fractal Agriculture. We partner with farmers to provide them a new form of growth and investment capital. So we're minority investors in land. So I don't have quite as much experience as the 95 years as Halderman, but we see a lot across the entire Corn Belt, essentially Montana, Great Plains, all the way through Ohio. And what we really do is we allow farmers to go further with the same cash flow. So how can you grow? How can you invest with that cash flow discipline, working with great lenders and other great land partners, so that those farmers can grow with discipline and keep family farms building stronger businesses.
Okay, thanks, guys. And we got the results in from the poll, the two poll questions. Interesting here. So where do you see land values heading in your region this fall and winter? 51% said probably stay flat. 20% said increase in value, and 29% said decrease in value. And then for the second one, how much land sales activity do you expect to see compared to last year? 51% said more activity, and 27% said no change. 22% said less activity. Thanks for all of you who weighed in on the poll. And we do want today to be interactive. So we might have another poll question coming up later here today, but in between time, would love for you to ask questions. The reason why we do these live is for you to get a chance to engage and to ask your questions. There is a Q&A icon, should be, I think mine's like in the center-ish bottom of my screen. So you can click on that and ask a question at any time. We'll try to insert that into our discussion today. A lot of times people want to wait till the end, and then all the questions come flooding in at the end, and we don't get to all of them. So if you have a question, don't wait. Go ahead and click on that icon and get your question in front of these guys as soon as you possibly can. But Howard, I thought maybe we'd start our conversation with you, and you just heard the results of the poll. I'm curious, if any of those results surprise you, and I'm curious if you could tell us, from your perspective out there, what you're seeing in the land market today.
Certainly, Tim. Happy to do that. The results of the polls don't surprise me. In fact, they are consistent with what we've seen in the marketplace. It has been one of stability and maybe surprising to some folks. Harrison, if you want to go to the next slide, I'm assuming we've got the Chicago Fed survey results there. There we go. So if you were looking at the poll and it said, 51% said the land values were going to be steady, This is the most recent Chicago Fed letter, and this includes the states of, the three I states, Michigan and Wisconsin. Michigan doesn't normally get enough responses to qualify. That's why you would see zeros for them. Interesting, first quarter this year was actually up for many of the states. The year over year, April to April change, two states actually recorded zero change. Wisconsin was up quite a bit. Indiana was down quite a bit. But the whole 7th district, a 1% increase year over year. So basically flat. I kind of, you can look at these statistics and say, is it real or not? Up 10% in Wisconsin or down 6 in Indiana. Our results don't show Indiana down 6 at all. But this is what the district showed. And I think that district number is probably the best one to go on. So when people are talking about predictions going into the fall, probably steady to slightly down would be what we would also consistently say. So Harrison, if we go to the next slide, this is the summary of Halderman real estate sales from 2013 to 2025. And let me provide a little description here. These are sales of farms that are 90% cropland or more, and don't include homes, confinement livestock operations, or overly improved irrigation, grain storage, etc. So basically, these are just cropland transactions, and we track them based upon so many dollars on the left, the dollars per productivity index. So WAPI is weighted average productivity index. And as you might know, many states rate their soils based upon their ability to produce corn. Now, this is not applicable to Iowa. This isn't really applicable to Illinois. These are Indiana, Michigan, and Ohio averages for the most part. We do factor in a little bit of Illinois sales, but Illinois' WAPI is different in terms of how it's rated compared to Indiana's. But basically, we take the sale price of the farm, say $10,000 an acre, we divide it by the weighted average productivity index of the soils. And if that was 100, that would equate to a $100 per corn bushel of productivity index value. And if you go back in time from 2015 to 2019, we traded at $50 per bushel of productivity index. And so theoretically, you could look at your farm and you say, well, gosh, my farm's rated at 150 bushels an acre, and take that times 50, and that would be indicative of your value. What was really interesting is, no surprise to anybody that's been in the farmland market, we saw inflation hit in 21 and into 22, and that has a direct correlation to farmland, and farmland values went up 40%. And so they went from $50 to $80. The last 3 years, honestly, have been pretty steady, right? In fact, 23 and 24 were lower than 22. 22 was the best farm income year, according to USDA, in the history of the United States, inflation adjusted. And so it ought to have the highest farmland values, right? What's interesting is our sales results through sales last week, Tim, show that 2025 is slightly above 2022 on a nominal basis, folks. This is not inflation adjusted. These are nominal values. If you put an inflation factor to this, clearly we're lower than what we were in 22. But just on a highline sale price number, so far in the Eastern Corn Belt, we're seeing that supported. Why? Eastern Corn Belt's different than West. We have a lot more densely populated states. You have other economies, data centers, developments for residential. All those things create some 1031 exchange money, and I would argue that probably makes the Eastern Corn Belt a little stronger value over time than the Western. Also, our farm tract size is smaller on average. Harrison, if you go to the next slide, I always thought this was kind of interesting, and hopefully you can at least see the colors, right? You don't have to read the numbers as much, but this is the percent of farmland acreage sold from 2018 to 2024. Dark blue is a higher volume. Light yellow is almost no sales at all. And you can see parts of Iowa experienced very little sales volume over that 6-year time period. 10%, which is actually that lighter blue, not the green color, but the lighter blue, is around 10%. If you divide that over 6 years, that's about 1.9% of the farms each year. So don't be afraid that all of Ohio and Minnesota sold. That's not what this is saying. Basically, what this is indicating is that Ohio and Minnesota had normal transactional volume, somewhere 2.5%, 3% a year, where Indiana and Iowa were below normal, and Illinois in a mix. So supply, and that's why we asked the second poll question that we did. Some folks, I think the majority, were expecting supply to kind of increase this fall. Fall is when we've seen the last 3 or 4 years more sales than the rest of the year. So I think that might provide a little more liquidity in the market, but at the same time, a little more downward pressure on values in some of these geographies. And then if you go to the final slide, this I thought was also interesting data. Ag Economic Insights just published this, 2-3 weeks ago, Tim. These are the mortgages filed at purchase from 21 to 24. So if you bought a farm and you had a mortgage on it, in tracking the data, so what this means is that in the region of the 3 I states, Minnesota and Ohio, not Michigan, the region total was 27.2% of the time there was a mortgage filed on a purchase of a farm. That's pretty low. You compare that to the residential space, the residential space is going to be 80+%. So farmland, 27. What's interesting, though, is the diversity of the states. Indiana, almost half the farms purchased in the state where I said had some mortgage put on them. Now, this isn't the percent of the mortgage. This is just that they had a mortgage. And then Ohio at 28, Illinois at 30, and then Minnesota and Iowa, very low percentages. So I think if you look at this, you'd say, well, where might there be a little more softness? In theory, a little debt might create a little more pressure. You'd say Indiana might see a little more softness because of that. I don't know that that's going to be indicative. It certainly hasn't translated into the market yet, but that's just something to watch. So in summary, I think farmland values are stable, maybe probably trending a little downward. I think we saw some statistics from Illinois and Iowa showing maybe down 3% year over year by some of the national surveys that Iowa State does or the University of Illinois does. But that would be very common when you see farmland incomes going down. And with lower commodity prices and interest rates kind of staying static, that would not be a surprise, I should say. And then finally, the other is supply. I do think you'll see some pickup in supply. We're starting to see some leading indicators of that as we book our fall sales. So I think you'll see that normal increase as we come into October, November, December. And that would be pretty typical. What will be interesting is, do we see it ramp up even more than normal? And that's yet to be determined, Tim.
And what's your feeling on that right now, or just kind of your feeling in the market versus these numbers? Does this, I used to trade grain, and sometimes it'd be like, what's the market today? Well, it's unchanged, but all the bids went away. Well, okay. What's your feeling out there versus this data?
So we watch our auctions pretty closely. We look at number of bidders, activity on them. We sold a farm a week ago, brought $15,000 an acre. It was an excellent sale, well above what the seller wanted. So you'd say, oh gosh, the market's doing great. Well, our representative said, there were a couple less bidders than what I expected. So we still achieved a good outcome, but fewer bidders. We had another farm sell on Thursday that struggled to meet the release price. It got sold because our sellers were willing to accept the market price, but it was one of those situations where it was probably rated below average. And I think you're starting to see a little more pullback on the below average, where folks say, 21, 22, I'd have bought anything, right? Farm incomes were great. But with 6%, 6.5%, 7% money and farm incomes falling, I don't need that below average farm. If it's next to me, yes. But if it's not next to me, I'm going to stay off of that, and I'm going to save my dry powder, my cash, for that farm that might come up closer to home that's above average. So premium farms, I think, are still going to command a premium price and do well, but those average to below average farms are probably where you're going to see some weakness.
And it sounds like what you're talking about with the Eastern Corn Belt is you're still seeing a strong investor interest as well. Is it kind of the investor interest, farmer interest? Has it been pretty steady, or is that dynamic changing at all?
We track that, and I didn't put that slide in here. Our sales last year, believe it or not, first time we had the investors buying a little more of the land at our auction or sales than what farmers did. So it was right at about a 50-50 split. This year, that's gone back to where farmers are at 60%, which is more normal. Uh, but the investors still exist, Tim. You've got residential developers around Indianapolis, Columbus, the Chicagoland area that are purchasing land, and that's creating 1031 exchange opportunities. You've got data centers looking at coming in because of the vast electrical network that we have, that are paying a very high price, $80,000, $100,000 an acre type of purchases for 100 acres. Well, that generates a lot of 1031 exchange potential. And there are folks that are looking to do that. So yes, to call them investors. Now, sometimes it's a farmer that's going to do the exchange, and he's just going to expand his farm operation with it. So to be clear, I wouldn't classify all 1031 exchange investors as investors necessarily. But yes, we still see the investor market in place. The institutional investors are still interested, but they're interested at a cash return in the mid threes. The market's trading in the mid twos. So you see them participate in an auction, but then they're done because the price is going to go above that, meaning that the farmer market is willing to accept a little lower rate of return because they buy for other reasons. It's their chance to expand their farm operation once of a lifetime, to own that farm down the road, and they'll bid on a property because of those reasons and accept a little lower rate of return. Again, that's cash return. I'm not talking about appreciation. Appreciation will be on top of those kind of yields.
Thank you, Howard. Yeah. Kyle, let's bring you in here too, get the kind of Western Corn Belt perspective. I want to give you a chance to kind of respond to anything that Howard just shared there.
Yeah, I think something that resonates with me that Howard said is the upper end farms here in the Midwest or Western Corn Belt seems to still be bringing a good amount of money. I'd say that the retraction, I guess, that we've seen is really in that middle level productivity type of dirt. Working closely with producers, a lot of guys are just like Howard said. They're trying to hold all their arrows to try and make sure they can buy the landlord that is getting older or looking to sell. They're trying to reserve their capital for the right purchases. I'm seeing a lot less activity on the public market, on the auction, on the listing side, and a lot of stuff on the private side. So a lot of the real estate deals I'm working are really private landlord buyout type situations. So that's been kind of a unique change here in the last I'd say year. Overall in the Western Corn Belt, we've seen a flattening for the most part. Iowa, Nebraska showing a little bit 1 year change down, here marginally. We do a little different in the appraisal team here at Farm Credit Service America. Does some benchmark farms, and so those farms get reappraised periodically, and it kind of gives us a pulse on the market. And Iowa shows a 1 year down 3%. Nebraska's down 1.5%. The outlier in this is really South Dakota, and South Dakota's seen an increase in land values, kind of up 11.5%. And I think a lot of that has to do with kind of the shorter day hybrids and the more productivity that South Dakota's been able to achieve here in the last years. So kind of one of those last frontiers. The real estate tax situation in that state is pretty favorable. So we've seen some increase there in valuation in South Dakota. So I think overall this land market, as you get into fall, it's really going to come down to what does this market do? Both from an activity of, okay, do I feel comfortable making that purchase, but also on the flip side of things, as operations encounter financial stress, how much land is kind of more or less forced to be in the market, so the supply goes up. So it'll be interesting to see what happens this fall.
And those benchmark farms, so you have just kind of farms that you're benchmarking throughout the Midwest, and so like South Dakota, one of them. Is that why you point to
Yep.
South Dakota? Okay.
Yep. So Iowa's got 21, I think. Nebraska's got 18, and South Dakota's got 22 farms. So it's kind of spread out across those states, and they're reappraised, I guess, from time to time, just to kind of see where the values are going in those regions.
And Ben, let's get you in here as well. I know you all at Fractal have been modeling farmland values for a while now. Kind of what are you seeing? Help us understand kind of where we're at and what got us here.
Yeah, I mean, the fact that we're investing like right next to farmers means that yeah, we track the high level trends, and I wouldn't want to go compete on that with our friends that we have here. I mean, we were looking at those local markets, and we all know that a local market for a farmer is defined by are there two aggressive bidders? That is going to set the price in a lot of situations. So, a couple of just things that we can continually see. One is we all know that farmland is driven by farm income, and farm income is variable based off the strength of those local markets. One thing we've had to add to our model these last 2 years, livestock values. So we've seen that hold up whole markets that you probably wouldn't have modeled that before. A good example is Nebraska, where after the ethanol boom, you saw a much deeper tail in Nebraska relative to the rest of the I states, been much stronger, much earlier on that. Similarly, where there's local development, or whether it's dairies in the eastern Dakotas on where that's hitting, like you see values strengthening there. I think where we've seen probably the biggest surprise has been to build on what Kyle was saying, is the amount of off-market sales as a proportion of total transaction volume. And that shouldn't really be surprising because a lot of those sales are folks that aren't in a great working capital position, and they want to keep farming. And so whether it's a sale leaseback, whether it's a sale to a neighbor, it's just some way to drive that extra little bit of cash that folks have. Those sales typically aren't your big auction sales because they're not always wanting to be made public on where those go. And so when we've been doing a lot of valuations with farmers, we present them all the data that we do to get to our valuation. The thing that I'm always surprised about, I show them this slide that has all the comparable sales, is they're saying, well, where the heck are those 10 sales? Because I haven't seen them on my normal auction websites. And the reality is there's a lot more that's happening. And I think that translates a lot into, what are you going to do as a farmer kind of moving forward to make sure that if you do have growth as part of your strategy, you need to be engaging a little bit more proactively with your banker, with your land manager, with your neighbors, just because it's just not as much of a wait and see for, that auction mailer to come across your desk.
Great. Yeah, thank you, Ben. We have some really good questions already pouring in. So if you have any question on your mind, go ahead and hit that Q&A icon at the bottom. The first one here is from Jay. Jay's asking, does the presence of a large dairy farm in an area such as Wisconsin or Michigan tend to create strong demand as a result of consistently positive value increases for tillable land? Howard, I know that some of that's kind of in your neck of the woods there. What's your thought on that?
Historically speaking, those larger livestock operations, and it's not just a dairy specific, but I think of Darke and Mercer County, Ohio, as an example. Those two counties are two of the highest populated livestock counties in the United States. And most folks wouldn't think of that because they're not large cattle locations, but they are huge in the poultry and swine production. And those land values there can be anywhere 25 to 30,000 per acre for similar productivity land that if you go a couple of counties away, you're going to trade at 15. Why? Well, manure application needs. So you see the same thing, halo effect around a dairy. Dairy has manure application needs. Dairy also needs feedstock. And so corn silage or other type of feed that can come in. Those types of vertically integrated operations, when you start to pick up other livestock uses, there's demand for corn, there's demand for silage, there's demand for alfalfa. So those create opportunities for local landowners to maybe capture a little higher rent. Higher rent's going to translate into a higher land value. And so, yes, typically you see a halo effect. Now, I want to be clear, that's for farmland. If it is a residential property that's a mile away from a dairy, that may not help its value. But that's typically going to be more of a planning commission and zoning issue than it is anything else. But yeah, it's livestock, and I think Kyle pointed that out with some of the stuff that's happening in Nebraska. Cattle are at an all-time high. So right now, beef is a very positive driver on farm incomes. And if you look at the USDA farm income numbers for 2025, what they're predicting, it's back up from 24. And then you're looking at me saying, well, Howard, you just said that you're going to see a decline in farm incomes. Row crop is down, but livestock's not. So I think that's a great question, because I think right now the livestock industry is pretty supportive of farmland values.
Right on. Thank you, Howard, very much. Kyle and Ben, did you have anything you want to weigh in on that before I take us to our next topic?
I think Howard covered that pretty well.
Great. Okay. Well, let's talk about kind of where this might take us into the fall here. I think I really appreciate the slides you shared, Howard, and I think that would give us a really good snapshot of kind of where we're at and kind of what you're feeling. Let's kind of go into where this might lead, and maybe to frame up this question. And Kyle, maybe we'll start with you. From a farm credit perspective. What are you seeing out there that might indicate where we might be this time, 6 months from now?
Yeah, as we look at kind of the financial standing of most operations in across our territory, I guess from a working capital standpoint, obviously working capital is near record highs 2 years ago, and so we're coming down off of some really good times. We've seen a lot of liquidity erosion here in the last 2 years, and that comes as a result of twofold. Carryover inventory that was, you put on a balance sheet at the end of the year at $6, for instance, a couple of years ago, and you ended up selling it for $4.50 or $5, and so you have a natural erosion there of liquidity that you don't even kind of realize until you go to sit down with your lender the next year and do your balance sheet, and it's like, well, where did all my cash go? Well, you didn't necessarily lose that next year in operations. You kind of went sideways that next year. Well, then you followed up. You did that again as you looked at price erosion once again, but then also doubled up on some operating losses. And so liquidity erosion here in the last couple of years has been pretty swift in a lot of operations. So as you look at kind of what we predict for the fall, I think it's really, where's your liquidity position, and then what is your cost structure as we go forward. So we want to look at what's your cash run equivalent on your own ground, what's your total debt structure, and what can your cash flow really support. And so I spend a lot of my time doing that with my producers as digging deeper into cost structure, liquidity position, remaining terms on real estate is a big part of it. If you have a lot of liquidity and you have kind of aggressive terms, can you get through it? Or do we need to look at stretching some of that out? The elephant in the room on that is the interest rate environment. And a lot of that stuff, a lot of those notes, we don't really have an option to extend them out with gaining cash flow. Essentially, we're not going to lower that payment. We're just adding term, and that doesn't feel very good for anybody. So we have a tendency to leave those notes alone that were made, 7-8 years ago in low rates, or even back in 2020. So we really don't have an option or a lever to pull in this downturn from a lending perspective to try and free up cash flow and kind of, put a Band-Aid on cash flow, so to speak. And so I think as capital positions tighten, operations are going to be forced with some really hard choices to make here as they go forward, depending on their capital structure. So that's going to be interesting to see how that plays out, and interesting how it affects kind of land values and the supply on the market.
Tim, I might add, there were a couple times this summer where we've had different engagements where, bigger crowd. You got other ag lenders, not farm credit necessarily, in the room. And the feedback I received was, there could be exactly what Kyle's describing. There could be some tough decisions to have to make this fall if we don't have a good year in terms of farm incomes. Now, we're having good yields, but the commodity price picture is not so rosy. And so I think what Kyle is saying is correct, is that are there some discussions that are starting to be had or will be had this fall that creates a little more supply? So if you say, well, Howard, what could drive some farmland value weakness? It is that increase in supply into a market that doesn't have super robust demand because farm incomes are down right now. And that creates a couple of things. One, maybe a little lower farmland value, which you'd say, well, that's negative on my balance sheet. That's a negative factor, but it also creates opportunities. And I think that's where Ben was going with, all right, if you're in a position where you could buy some additional acreage, there could be some opportunities come up that are created because of this. So is it going to be like 2014 and 2015 where we saw a 10 to 15% decline in farmland values? Certainly that could happen. That would be a very healthy correction in basically responding to the lower farm income environment that we're in. At the same time, you have a lot of other economic activity that is supportive. So I'm not predicting that, but could it happen? It could. It is not going to be a crash and burn like you saw in the residential space in 08, 09, or back in the 1980s in farmland, because you don't have that kind of debt structure out there. And I don't know, Kyle, if you want to have any comments
Yeah.
on that, but the debt levels are not at that position. So I'm not predicting any of that. It's just you could see a slight correction because it's indicative of farm incomes.
Yeah, as you look at the capital strength within this industry, that I mean, they're on average, liquidity is still pretty favorable, but averages are only one number. And so you have a Jekyll and Hyde scenario where there's a lot of guys that have kind of, for lack of a better term, rat hold some liquidity, and they kind of wait for these opportunities to strike and expand their operations. So do I think that more supply is going to be super detrimental to the land value market? No, I don't, because I think there's a lot of people sitting in the weeds, kind of waiting to strike. And so I think there's a lot of liquidity, a lot of capital ready to go to market here to purchase some ground. Do I think there's going to be local opportunities that kind of fall through the cracks? Certainly, I do. I think a lot of those producers the larger producers that are saving the liquidity, have certain quality of ground in mind, or certain farms even in mind. So I think the capital positions really is vastly different across the footprint. So it's kind of all over the board, I guess. But there is certainly some that are getting pretty tight.
Kyle, that's exactly what we're seeing from a lot of our customers, where it's, especially if you're sitting in a spot where you've had that conversation with your banker, you know how far you can go. You know what your debt service supports. You know how much, in your local market where you could go. What are they going to go do? And it's often taking advantage of off-market opportunities, shoring up their landlord base, but especially if you have the equipment and that labor to actually support another 100, 200, 500 acres. Those are going to be the most profitable acres that you could bring on board, and it's a hell of a time to go do that because you're actually decreasing your cost structure, which gives you resilience if that 10 to 15% happens, as Howard's saying. And again, that's going to track with the farm economy. So you're strengthening the operating business that you have, and you're expanding that real estate footprint. And that's kind of where we've spent most of our time with folks, is how do you get proactive, with those existing partners that you have, and then where do you bring in a tool like Fractal, another investor who's going to take some of that risk on the land market with you, but hopefully keep you in control, because that control is going to be really, really important through this, because we don't know if we have another 6 months, 12 months, 24 months of this. And you have to be planning for, okay, what is your farm going to look like 10, 20, 30 years? If you're in the pure commodity business and don't have a niche, you're going to have to scale to just be effective on that. And you need to start now. And it's a hell of a lot easier to scale, at this part of the cycle than when Howard has half the county at every one of his auctions, and Kyle's willing to lend everybody a heck of a lot more money on there, because competition is a very, very real thing.
Ben, you kind of mentioned Fractal coming in and investing alongside of you. Could you give anyone who might be here who has never heard of Fractal just the real basic, like what exactly you mean by that?
Yeah, so we invest with farmers to give them an equity capital solution. So we want to be a complement to the great ag banks that we have in our system. And so what that means is we will invest as a minority partner. Farmer stays in control. We lock up our capital for 10 years. In other words, we can't exert any control or force you to sell, or we can't sell our position. And what that allows you to do is that allows you to, we'll invest in a field that you have right now to go take that sale or that capital to go make that next purchase. So it's, how do you go take advantage of that opportunity when someone like Kyle is saying you don't have the working capital to go do that, but that field will cash flow up to a certain level. Because we are so much cash cheaper than debt, we can help to complement that. And so you're going to use us with your debt partner just to solve kind of that down payment gap that exists. And then with us, at the end of that 10 years or whenever you buy us out beforehand, if that market's come down, we're going to ride that with you at that 10-year point. And if we go up, we will share in some of those gains. And so it's not a silver bullet, but what it does is it takes a well-prepared, solid business producer and puts them in a position to be able to make smart investments that help with their cost structure, help build a better business. Oftentimes it's growth, could be a landlord buyout, could be drain tile, could be storage or a grain dryer, something that helps, and just takes it a heck of a lot further.
Well, I want to move this conversation into to kind of like, well, what do we do about all this, right? So what can we do, right, to put us in a good position? But let's get to a couple questions too along the way here. First one, Kyle, is for you specifically. It's asking, do you think there will be excuse me, do you think there will actually be forced sales? It seems Farm Credit and other lending institutions are rarely actually requesting land sales to cover debts.
Yeah, I don't know that forced sales would be the word I would use there. I think there's going to be just a lot of, hey, your liquidity is such that we're looking for you to strengthen that. And like we talked about, we touched on, last downturn we had low interest rates and we were able to restructure some debt, right, and do some stuff from the lending side to do all we can to help. At this point in time, there's not that lever to pull, and so producers that are in a tight spot are going to be forced with hard decisions. And it's more of a, hey, you need to bring in additional liquidity into your operation. And the answer in a lot of cases at this downturn looks like it points towards an asset sale. And so whether it's an outside investor, cash coming in or an asset sale, that's the reality. As I talk to my acquaintances in the banking world, it sounded like their renewal process this spring was very tough in a lot of these banking institutions. And so that was something that I guess I see being an issue as we go forward if things don't turn around. We're sitting here at really low prices as we're going into the fall.
Yeah, Tim, I don't think I'd characterize it as a forced sale. Recommended,
Yep.
or you asked the question, what do we do? Well, I think understanding your balance sheet, knowing that you don't want to pay off those low interest rate mortgages that you've got in place. You don't want to consolidate your debt, which you hear about with credit cards and other things like that. Maybe if you've got credit card debt, you do, but you don't really want to refinance those. So you're going to keep those in place. So the question is, if I need to create liquidity for an opportunity or to operate in 26, how do I do that? And being proactive historically has always paid off. So having that discussion with your lender, having that discussion with somebody like Fractal to say, what are my options? And then weighing those out, what's going to be the cost of each option, and what puts me in the best position to keep this operation around long term, because that's the ultimate goal. And your lenders, the beauty of farm ag lending, especially when you talk about somebody like Kyle at Farm Credit, they've done this for many years, and they've got a history and a track record. And somewhere at Farm Credit Services of America, I'm betting they've got folks that lived through the 1980s. And so the beauty of that is they've got that historical knowledge that farming isn't always consistent. And so there is variability, and they're willing to work with you. And all of your ag lenders do that. They know that. So how do we work through this little downtrend? Because that's all it is a little downtrend. And how do we work through it? And how do we get in a position to continue to operate long term? That's really the discussions you need to be having.
Yeah, it really comes down to, are you willing and able to make changes just to survive the market downturn, right? Like,
Yeah.
what are you willing to do to help manage through this process? And if you have liquidity, that's a really a forgiving thing. And so if you don't have liquidity, it's what are you willing to do to get that liquidity to survive the downturn? If we lose $100 an acre this year and $100 an acre next year, where does that put your balance sheet in 2 years? And that's really a lot of what we do is look at cost structure and try and help manage through that so that we can survive the downturn and come out the other side making good profitability.
Kyle, like what you said in terms of like actually penciling out those downside numbers, I've had two farms come to mind who I've spoken to in the last month and a half. They wanted to go do a deal with us, and their finances just frankly weren't in the right position to do something. We work with kind of growth. We're not doing distressed out there. Just that's not our business. But what I noticed through that process was like we walk through, this is where we see your balance sheet, where I think your loan renewal next year might be a little bit tough, which makes it really hard for me to do business. I got a text 2 days later, and it was like, I am so relieved after that conversation because he knew where their business was at. They're a damn good operation, and they know the three levers they're going to pull to go strengthen that. And then we're going to go hopefully be part of that and go do a deal. And so, even just emotionally, like addressing it head on to be able to have that conversation with whoever you work with your banker, with your accountant, if you have an ag consultant, go out and be proactive because my guess is Kyle's going to be really busy October, November, December, January. And if you're that person who's up ahead of the curve, that is going to be really beneficial. So that's kind of like one thing that we've seen that's just so absolutely critical.
Yep.
The Kyle, I'll let you go.
Yeah, no, I'd say my role really with Farm Credit is more consultative than it is as a typical lender loan officer. So I'm down sitting at kitchen tables, periodically 3-4 times a year with my producers, going over our projections. So we start in the spring with a baseline projection, and we're looking at actuals as we go through the year. I think that's vitally important to know your cost structure, know where your break evens are at, so you can really show your lender this is what, based upon the like for this year, we have huge yields out here in Western Iowa. And okay, at baseline yield projections, we probably looked at a liquidity burn and equity sideways type of a year. At this point in time, we're looking at a slight equity gain and kind of holding liquidity together based upon some of the yield projections we have in a lot of these areas. So that's vitally important to really know that and know those numbers, be able to show those to your lenders. We do a kind of a projection model that shows what the balance sheet would look like, so it pairs what your projection looks like and the effect that will have on your balance sheet. So that's really a big piece of just knowing where you're going to be as you go into the fall. And then you can run scenarios on, if I buy this ground, what does this look like on my financial statement? Is this sustainable for me long term? That's really important.
Yeah, and Kyle, I think like what we see is when you have that baseline, then you can start thinking about with very clear eyes about what is next and whether that's something that comes up to you opportunistically or something that you can go out and go look. So we always urge folks like just write down what you think those can be. All your landlords, who do you think is most likely to sell? And you know there's gonna be one or two that might surprise you. How much ground could you pick up without your lender freaking out on you? And you feeling good about this, the stability of your business, number one. Two, what is your equipment? What other CapEx do you have? Do you have really high ROI projects, drain tile, storage that's not optimized that could actually decrease your cost structure across the whole operation? Are you saying no to things that are damn good business decisions because of liquidity that's out there? Like maybe you are, but you should know what those are. And then three, like what is like where are you trying to go in 5 to 10 years? And like, do you have a little bit of liquidity? How far can that take you? And kind of bounding that. There's a really good podcast that AgView Solutions just did on opportunities. It was about a month ago on that like walk through how all of the other dynamics beyond just the financial side of it. But I think what I got out of that was, there's a lot more creativity that you can do to take advantage of some of those opportunities operationally. But you really need to know where your books are. And like that's one of the big problems we're trying to solve here is because we're cash cheaper, we want to keep you in a good spot with that lender that you have, but take advantage of 2, 3, 4 more of those either projects or land sales without losing the discipline that you have that you need, not just for your banker, but to build that business. Because we don't say growth, growth, growth. Like that is not a good way to grow over a 10, 20, 30-year time horizon. That's a good way to go broke. It is that disciplined growth, but also taking advantage of the fact that, there's going to be more opportunities like you heard and like most folks said that are out there. And this is the time that you're going to see them. And we know how long it takes for that piece of ground to come up for sale again, especially in a place like Iowa where it's what, Kyle, 60 years, 70 years on average?
Yeah.
Not very often.
Yeah, so if you work through numbers with your lender, with Fractal, and maybe the answer is, well, you got to maybe have an asset sale to generate some of this liquidity. Could you take one of those farms that's a little further away? You think about your core operating area, your headquarters. Maybe it's a below average farm you bought 4 or 5 years ago, and it's 10 miles away, 7 miles away. You say, that's the coupon I'm going to cash in, the chip I'm going to cash in to generate some liquidity, but I want to keep farming it for whatever, got other farms in that area, whatever. Calling somebody and doing this early, getting a hold of somebody like Halderman and saying, hey, I'm looking at selling this 160 and I want to do a sale leaseback. Here's the pricing. Here's the kind of the cash return I can provide, and working with that broker because I was on a call yesterday with a residential developer that's got a landowner that's going to want to do a 1031 exchange. We have those kind of contacts. So by putting those feelers out early, you can be on the front end for other investors to come in. And these are passive investors. They're not going to tell you how to farm. They're not going to dictate to you. Yes, they want a fair rental rate, but they're not going to dictate to you on how you're going to do your operations. And that, I think, being proactive is what you're hearing throughout this conversation. And there's a lot of different levers you can pull. Sale leaseback is one of them.
Well, so to level set for our last kind of 15 minutes here, we're hearing there's likely going to be opportunities this fall, right? We could be seeing some increase in inventory, some increase auctions based on what Howard said earlier. Also, at the same time, we're likely not going to see a crash based on the financial situation, the financial picture out there. So this opportunity, could be quick, right? It could be kind of a window that you can hit. And so to hit that window, I'm hearing be proactive. I'm hearing be disciplined. But I'd like to maybe in this last 15 minutes get a better sense of what that looks like to actually pursue these opportunities to make sure you're not overextending yourself. You're prudently growing in a disciplined and proactive way. What's that look like? And we'll take this one around the horn because I think you all probably have thoughts on this. Ben, I know we've already shared some ideas, but for a farmer who is looking to kind of take advantage of this opportunity, but make sure they're in position should it arrive. What are you seeing the top performers do versus the underperformers?
Yeah, I mean, I think we've had a very large influx of folks that we've known for a long time, even since the 4th of July. And so if you're not getting on the phone right now to understand what your options are and what that extent is, we have a whole pre-approval program that we do, which is similar to getting pre-qualified for a loan. Takes, it's probably going to be 3-4 hours of your time to get that data, and that's so you are ready to strike when the iron is hot. We like those preparers, and we really urge people to be doing that alongside that same banker conversation because I want the banker to know what their option is with Fractal, and I want to know kind of where that banker sits. So that way, when that really big or that really unique opportunity comes, like we're all on the same page. So it's the numbers, but it's also the people that comes in. And then, from that side, it's then understanding kind of what does it mean for your operation to either take that opportunity or not. Sometimes when there's a landlord sale and you can't make that happen, that can actually impact your whole cost basis because those fixed costs aren't being spread out. So you need to just have that firm grasp of reality, but you need to act on it as well. And I know we're coming off a busy field work season, and we're going to have there's a lot of crop that needs to be harvested. But doing stuff right now versus being reactive during and after harvest, I think is going to be a pretty massive differentiator from people. And now excellence is often the capacity to take a little bit of pain and hopefully a couple of hours. Kyle will be less painful because he's a lot more enjoyable than someone like me. But a little bit of pain to go have those conversations can go a long way.
Kyle, what would you add to that?
Yeah, I think I did just really continue to echo that lending relationship, preparing yourself, knowing your financials, knowing your numbers, strongly encourage producers to not just have a one-time meeting with their lender, whether they're doing the operating renewal, going in one time a year, updating their balance sheet, get feedback, ask questions, be inquisitive, and let them know, I'm looking to grow. I want to buy some ground. Is this feasible for me right now? And having those conversations periodically through the year, even if it's twice a year, any more frequency you can get in with your lender and let them know where your thoughts are, let them kind of get their head around, if that trigger were to be tripped, what plays do we have and what does that look like for the operation, and get feedback from them. I would strongly encourage to have a really good relationship with your lender and be open and honest.
And Howard.
So Tim, a couple of thoughts. Here's one that I hear from producers or land farmers that I hear being successful or see being successful. And a lot of them say, I try to buy one farm a year, every year. Think about that. You're averaging into the market by doing that. You're not going to hit all the highs. You're not going to hit all the lows. You're not going to hit all the highs in interest rates. You're not going to hit all the lows. You're going to have a portfolio of farms at different price points, at different interest rates. And so that one farm a year, that's something to kind of think about for the younger growers out there that are looking at how, and somebody said earlier, you try to do 5 at once, that could be a recipe to be broke. But how can you pace yourself, so to speak? Ben brought up a really good point. What happens if that landowner comes to you and says, hey, we're going to sell the farm. We want to offer you, Mr. Tenant, the opportunity. And you as the tenant say, I'm not in a cash position to do it. Well, you call Ben. Maybe he can help you. Maybe he can't. You call your lender and they say, nah, maybe not right now. What's an option? Well, an option would be to call a broker and say, hey, Alderman, I've got this opportunity to buy this farm. And believe it or not, the landowner, because I'm the tenant, is willing to give me a little favorable deal. That is something that the institutional farmland market or those 1031 exchange buyers are looking for. And so we could provide the passive capital to come in and replace that landowner with a new landowner, and you keep operating it like you always have. So those are things that exist out there. But the last thing I will point out, think about your area. Have there been a lot of farmland transactions or not? Because I would suggest that as we go into this fall and supply ramps up and you got consistently interest rates at a higher level and low farm incomes, where their opportunities will come up will be at sales where a lot of other sales have occurred in the last 2 years because a lot of liquidity has been sucked out of that marketplace. And at every auction, I tell our sellers this, okay, Mr. Seller, we're going to go to this auction tomorrow. You got 5 tracks. One of them is going to bring way more than you ever expected, and one is going to be less than what you expected. But you're interested in the wholesale price. At every auction, there's an opportunity. And a lot of times there's one track that doesn't bring, and what I see a lot of times is everybody's focused on tract 1 because that's the premium tract. And then it goes above your level and you're out and you just shut down. Well, reality is there might be an opportunity on one of those other tracks that could be attractive. So being in a position to take the advantage of those and being proactive and being ready is kind of the key, because those opportunities will come up more this fall than what they have the last couple.
Yeah, I think it's evidenced by an increase in no sales in across kind of the Midwest. Correct. And so you look at the seller mentality is like, well, I'm going to no sale this today. That I think that changes as we get into the fall and we look at, the reality of sellers going into those auctions are going to have a better feel for, okay, the market is soft. My reserve, so to speak, will be a little lower. I'm willing to kind of accept and walk away from this farm today.
Absolutely. Yeah, and I mean, with that kind of on the horizon, this proactivity message, I think, is a big one from today's webinar. Be proactive, reach out, to someone like all 3 of these panelists here. In fact, if you do want to learn more about Fractal, there is another poll, I think, popping up here that they can follow up with you about this kind of pre-approval program that they have and just kind of understand if it might be a fit for you and your operation. If you want to just complete that poll, that'll get you in with them, and they will reach out to you and can talk to you about that pre-approval program. And of course, you can reach out to Howard and Kyle as well about those options. Having these options and being proactive, I think, is a big takeaway from today. And before we do wrap up, want to give you each a chance to kind of offer some closing comments or, some kind of calls to action before we leave. I have a couple more questions I do want to get to. The first one is do you see lenders willing to take the risk in order to allow farmers to purchase below market land? Blake is asking that question. Kyle, how would you respond to that? Do you see lenders taking the quote unquote risk, it's in quotes, in order to allow farmers to purchase below market land?
I think it's a case-by-case basis, but ultimate answer is we're not farmers, right? We're lenders. And so risk we want to mitigate as much as possible. And so if it's an opportunity that, we have some debt that's going to roll off here in the next couple of years and you have a liquidity position, is that risk? I don't think so. But we're willing to work with farmers on a case-by-case basis to try and make something happen or get a deal done for you. But I wouldn't say we're in the business of looking at high cost producers and high fixed costs and running long term or interested in that as we go forward. We're willing to work with you as much as possible, but at the same time, your cost structures and your capital structures got to be very, very good. Yeah.
But Kyle, you have money available to lend.
We do. We lend money every day.
Taking the foot off the gas.
Yep, correct. And
so
it's really being responsible. It's really being responsible with the capital and deploying capital in the right way.
Exactly.
Great. And Howard, this one, maybe you can take this one from your perspective. It's more of a general question, but Galen is asking, what's your perspective on commodity prices and yields and impact on farmer decisions to sell, especially with aging farmer population? Kind of speaks to a lot of what we've been talking here in terms of trends, but curious if you could address Galen's question specifically.
Well, Galen, first of all, I've noticed an uptick a little bit in equipment sales. I think the used equipment market is soft. And so I'm looking at that and saying, if I'm an older producer, I've been through a really nice run, right? 2020, 21, 22, 23, really some pretty decent years. And now, man, it looks like the next couple of years might be a little tighter. Maybe now's a good time to retire. I'm 68. So are you going to see some of these older farmers transition out of operations? Yes, I think you will. There will be more consolidation. That happens in any downturn of any industry. Does that mean more farmland sales, though? Not necessarily. Most of those farmers they might retire, but they'll keep the land and they'll rent it out. So I wouldn't anticipate a lot more farmland sales from that, but certainly more equipment being available. The other thought would be on commodity prices and the impact. So it's a combination, it's revenue. And as Kyle pointed out, yields are going to be pretty strong. It really will come down to that revenue side. I heard an interesting comment from one of our area representatives earlier this week. He said, I'm recommending to sellers, if you're going to sell this fall, do it earlier. There will be more positivity in the farmland marketplace around great yields than maybe what they'll be feeling come December, when the glow of a great yield is a little less and the reality of lower prices is facing them, and they got to go talk to their lender. So that I think kind of gives you a little insight as to the impacts. Positivity, mental outlook, emotional, that certainly factors into our auctions. And I think there's going to be more positivity around that as we go through the balance of the growing season, because we're looking at really good yields. And at the end of the day, what does a farmer love to do? They love to grow corn, and in the Corn Belt, they love to grow corn, and they love to harvest 250 to 300 bushel yields. And that's going to be a real positive feeling. The reality is probably prices offset. And well, my total revenue is $800 an acre. My break even's $800 an acre. That doesn't feel real good from a financial standpoint. So that's more what happens in December and January.
Yep.
So just a thought on that and timing.
I appreciate that, Howard. All right. Well, we're getting close to the end of the hour. I want to give each of you a chance to distill down some of the nuggets from today's webinar into some final takeaways, some final thoughts. So we'll kind of go around the horn for that. And Kyle, if you don't mind, maybe we'll start for you. Just anything you want to either add or emphasize onto our webinar before we close out here.
Yeah, I think really the big takeaway for me, and the big thing I would leave with you is like I said before, just really be prepared and know your financials, know your numbers really, really well. And if you don't, it's never too late. Start now. Start looking at what your actual costs are for this year. As Howard commented, this is going to be a tight margin year once again, and so we know that takes an impact on the financial statement. Yields do feel really good, but the margin's just not going to be there like it maybe was a couple years ago, right? And so really be in tune with your lender, be in tune with you folks, and try and come up with ways to be ahead of the curve that those capital outlay projects, or whether it's real estate or whether it's a bin, or whether just be prepared to have a plan in place to go forward.
Excellent. Howard, why don't we go to you next?
You've said it multiple times, Tim. Be proactive. That's what Kyle's saying. Be proactive. Don't come to me on December 1st and say, I need to sell my farm before the end of the year. You're not going to get maximum price out of that. And so I just throw that out as an example. But when all of a sudden you're under the gun and you got to get something done in a 30-day time period, you want to maximize your sale price, you're putting your broker and yourself in a tough spot. So being proactive and planning ahead in anything you do, rental decisions, sale decisions, machinery decisions, it is going to require more management time and more thought, and really probably more conversations this year than what it normally does. But that's okay. Those that do it and plan ahead, they're going to come out the other side in a position to take advantage of opportunities.
All right, Ben, bring us home.
Yeah, I mean, I think I just echo these guys on the proactivity. I mean, when it comes to us, like, we already have a line, and where that line's going to get longer, and we like long-term relationships with the folks that we work with. And so, give us a holler if you think something like us is going to be a fit. I mean, we really work with the folks that want to be farming in 10, 20, 30 years. And when we look at where the market's at right now, we aren't like we've just spent the last hour talking about where we think the market's going. None of us know. right? And so it's having a plan that can weather multiple scenarios. How do you remove a little bit of that emotion out of it? So we have like just the groundwork of here are kind of the numbers. Here's where different capital providers can bring us. So give us a call, schedule that banker meeting before you probably give us a call, and we can do that in parallel. Make sure you meet your local land broker, or if you're out east, obviously Howard's trying to get your business in that. But there is probably more opportunity right now than there will be in 3 or 4 years when we see that turn. And that could just be maximizing your mixed costs, maximizing what you can do with labor and equipment today, so that way you're generating more cash on that upswing. It might be getting proactive with those landlords, or it might be, actually being able to take advantage of one of those bigger sales that you probably wouldn't have been able to a couple years ago with the amount of competition, as long as you're within that discipline of your financials and making sure it all fits kind of where you, your family, your business partners want to go. Because none of this capital stuff's a silver bullet. It's just good, darn smart farms, just planning and executing on a business that's going to work for that same time horizon.
And if you're thinking, that's a good idea, I should be proactive, I'm going to start that next week. That's not how proactivity works, right? Proactivity means you're going to do it like right now, like right after this webinar. So make sure, you're reaching out to Fractal, you're reaching out to your local farm credit lender, you're reaching out to Howard at Halderman. Get these people on your side for when you need them. And like I said, proactivity means like right now, not like soon-ishness, right? And I'm going to do something very anticlimactic. We've got one question left, and it's just bothering me so much that we haven't got to it. Jay's asking, and this, Howard, this is for you. For recent and upcoming sales, are sellers 1031 exchanging into other real estate, or do you see more people just biting the bullet and paying capital gains tax?
It's a mix. If you go back 20 years when you had the big real estate boom in the early 2000s, and a lot of tax deferred exchanges out of Chicago, Indianapolis, Des Moines, everybody didn't want to pay capital gains tax. But capital gains taxes are at 20% now, so it's a lot lower than rate than what it was then. Interest rates. So we had here's the mixed. We had a guy come to us 3-4 years ago. He said, I want to do a 1031 exchange out of this sale to this residential developer, but then interest rates go up and his CDs can earn 4.5%, and farming is 2.5%. And so when he looked at paying the tax and investing in CDs, his income was actually going to be more out of the CD. So it's a mix. I think that market is a little divided. I don't know that it's 50. Yeah, it's probably 50-50 with I'm going to pay the tax and take the cash versus let's do the 1031 exchange.
Yeah.
So still active in the market, but it isn't 100% one way or the other.
Thank you, Howard. Thank you for indulging me on a bonus question there. We had some bonus content before the webinar, bonus content after webinar. So I don't know. I think you got your money's worth here today. Thank you all for joining us. Thank you so much to Fractal, to Kyle, and to Howard for being on this. This has been a really, really great session. I hope you do take their message to heart and be proactive here going forward. Thank you all, and wish you the best for the rest of this year's growing season. And we'll sign off from there. Thanks, everybody.
Thank you.
Thank you.